Good evening, ladies and gentlemen, and welcome to our class on building a trading matrix to take advantage of important economic events. Tonight's class is sponsored by X90, one of the world's leading Forex and online trading providers. When you trade with X90, you can trade shares from around the world, including US, UK, Germany, France, and more. You can trade stocks with leverage. You can buy short or sell long on any stock and receive dividends. You get real-time quotes and no commissions. You can also trade indices, commodities, and Forex with X90. And you can take part in their bonus program and get some extra trading in from one of the most safe and secured platforms around. You can start funding your account for as little as 100 euros and be trading CFDs on stocks, Forex, indices, oil, more, gold in no time at all. You can use your credit card, PayPal, Skrill, or a wire transfer. But in the meantime, you can go to www.x90.com and set up a demo account real quickly. And if you want, you can actually follow along and see how the assets moved in today based on the economic events on today's calendar. Now, trading the news can be very profitable if you correctly guess which way it's going to move. Price can move as many as 30 or 40 pips very quickly on big news releases, but knowing which way is going to move is very much a gamble. So most traders do not trade the news, as it's just too risky, and you often get stopped out as price moves one way and then the other. Most traders experience this whipsaw effect when prices go up and then down very, very quickly, or down and then up. So it seems no matter which way you trade, you can always seem to get stopped out. But then trading from the economics calendar is slightly different than trading news. Economic events are very important and have an effect on the currencies that are being traded. Now, some news releases are more important than others, like the NonFarm Payroll report, which we're going to talk about a great deal this evening, because that comes out on Friday, or inflation data or central bank announcements typically move the needle more than most. And there is good reason for this. Central bank announcements like rate hikes directly affect money supply, which has a major bearing on the economy, while CPI, inflation figures, consumer price index, or unemployment numbers can influence central bank policy, which, like we saw in the U.S. just a week ago when the Feds raised rates again, or we also saw it from the Bank of England when we started to see them become a little bit more hawkish. They haven't done anything yet, but the fact that they're starting to think about an increase has had an effect. Or the Bank of Canada, which became very hawkish, and we're expecting a rate increase from them sometime probably in the next 6 months, which helps support the currency in that country. These days, sophisticated algorithms are able to process news releases in the blink of an eye and move the markets accordingly. Financial markets, therefore, adjust quickly to the new information. Even so, the biggest news releases create opportunities in the markets because they can cause long-lasting price moves or momentarily distort the efficiency of the markets. Now, the economics calendar, which we're referring to, is a tool, and it puts together all the major economic events happening around the globe. It's published every day of the week. Okay. And it puts together all of these economic and political events, puts together all central bank events, puts together meetings like the G7, the G20. You'll know what is happening well in advance. It also helps give you the estimated value, what last month's value is, and what next month's value is. So economic and political news can change the direction of a currency pair in seconds. The fundamentals that are true in an instant of time can be rendered absolutely meaningless by fresh fundamentals a second later. The economics calendar enables traders to keep track of economic indicators and political news that impact currency movements. So believe it or not, there are a large number of amateur traders who ignore news events and economic releases completely. They concentrate solely on technical indicators and chart patterns. And that's because a lot of people told them not to trade the news. Well, we can mix up news events or economic events with headline events. Trading headline events, comments, economic comments, Donald Trump tweets can be very difficult. But trading economic news, because this is trading from pure data, can be very successful. Economic data tends to be one of the most important catalysts for short-term movements in any market. But this is particularly true in the currency market, which responds not only to U.S. economic news, but also news from around the world. With at least eight major currencies available for trading, there are, and 17 derivatives of them, there are always some piece of economic data slated for release that you can use to trade your position. Now, trading news is harder than it may sound, but not only is the reported consensus figure, but so are the whisper numbers or the revisions. And we're going to talk about all of this when we talk about forecasts or consensus, and these whisper numbers and revisions are very important. Okay. Now, first we have to understand what type of events we find on the economics calendar and what type of events are important enough to affect the movement of a currency or an asset. So we have inflation, we have interest rates, we have public debt, we have political stability and economic performance, terms of trade, and current account deficit. Does anybody know why these would affect currency rates? Well, inflation rates cause currencies have an effect on the currency rate because the lower the inflation rate or the higher it is, the more value your currency has. For instance, if you have high inflation, your currency in your country buys a lot less stuff. So when the U.S. economy goes, when the U.S. inflation rate goes above 2%, what happens is the price of goods are going up on the shelf, so your dollar buys less. So it has an effect on the currency. Now, because in most countries, the central bank's mandates, especially the U.S., are to keep stable and low inflation, it's one of the reasons a central bank will act. And therefore, it's an important number because everybody's concerned with central bank action. It's primarily one of the most important aspect of all the economic events is how will the central bank react to it? What is the economy like? What's it doing? Where's inflation going? Where are jobs going? So what will the central bank do? So interest rates are crucially important because the central bank controls interest rates. The change in interest rate affect currency values and dollar exchange rate. Forex rates, interest rates, and inflation are all correlated. And you have to understand how they go together to actually trade these economic events. Because I've seen economic events come out very, very good, much better than expected, that should have sent the dollar soaring, or should have sent it, if it was bad, should have sent the dollar down. But it didn't because it changed the way the markets viewed what the central bank would do. So increases in interest rates cause a country's currency to appreciate because higher interest rates provide higher rates to lenders, thereby attracting more foreign capital. And this is important. Higher interest rates attract foreign capital to invest in your country, okay, and bring in those foreign dollars, which is very, very important. So this is what the market is looking at when these pieces of data come out. Now, an important piece of data is a country's current account or balance of payments. Because what a country owes or how much is importing goods or exporting goods is crucially important to, again, to people investing in your country. So balance of payments affects exchange rates of its domestic currency. Then government debt. Okay, you always hear about people talking about the U.S. government debt. Okay, the U.S. government owes trillions of dollars. Well, if investors at some point start to worry, and we're not talking about you and I as investors. We're talking about foreign investors, hedge funds, countries who buy our debt, China who buys our bonds and our debt. If they think that our debt is getting, or any country's debt is getting too high and there's a possibility that they couldn't pay it back or they would have to cut it down like you saw all the Greek haircuts, foreign investors will stop buying into that market. When foreign investors stop buying the bonds of that country can't raise money, and a country needs money to function. So as a result, a decrease in the value of the exchange rate will follow. Then you have terms of trade. And terms of trade are all dependent on how solvent a country is and how well it can trade in the public markets. So all of this ties back to the economic events that are being released. And all of these are put together on the economics calendar. Now, I'm going to tell you a story about your kids and their report cards. Because what we heard about, these were all like the classes or the grades that a country gets on all of these events that we were talking about. And it's like giving a report card on how the country is doing in the financial markets. Now, the economics calendar puts all this data together. All this data is rated, and which surprises most people, in a 3-tier rating system. It's a standardized rating system. And there's level 1, level 2, and level 3 data. Level 3 is the data that's critically important to the markets. And at the same time, level 3 data is the only data that will cause huge market volatility. Level 2 data is important data, but doesn't usually cause volatility, or level 2 data is put together with level 3 data as a subset of a major report. And then you have level 1 data. So imagine it's like your kids' report cards. Level 1 data is like gym. Level 1 data is like home ec class. Level 2 data is his foreign language class, maybe his social studies class. And level 1 data is his science, his math, his important skills, his English, his reading. Okay. Now, all of these are on this report card to rate the economy, or to give you some idea of how the country and the economy is going and the value of the currency. Okay. Now, it's important to remember that all of these events are on a calendar. They're all scheduled. We also know what the events were last time they were released. So it's just like your kid's report card. You're sitting down at your dinner table with your kid, and you say to him, well, kiddo, report cards are due on Wednesday. It's Sunday now. How did you do? Well, he first says to you, Mom and Dad, as you remember, last semester I brought you home 4 C's and 4 C pluses. They said, yes, we remember. This is called the previous, okay, which is what you get on the calendar. Because the minute the data came out the last time, that became the previous for the next time. He says, well, I think I did a little bit better this semester. Maybe I'll bring you home mostly C pluses. Now, because your kid's pretty reliable, pretty dependable, you had a good kid, you set your expectations at mostly C pluses. So you adjust your expectations, And of course, you do the parental thing. You give him a lecture about his time on the computer, his time he was playing sports, instead anymore if he wants to get into university. But you don't go back and do any analysis. You haven't gone back to the school and talked to his teachers. You haven't talked to the school board. You haven't found out that they're changing their grading or their rating system. None of this. You just know what the data is. And that's the thing about an economics counter. It gives you straight data. It doesn't give you data that's been analyzed, turned upside down based on the economy, washed in and out by some analysts, and then fed back to you. It's giving you straight numerical values on straight numerical calculations with no analysis interjected. So you're getting the same hardcore data as everybody else because it all comes through direct data feeds. Now, come Wednesday, the kid comes walking in from the backyard, hands you his report card, goes running out the back door to play soccer. You open up the envelope, and what is it? It's all B's. You're thrilled. You're ecstatic. You holler out the back door, hey kiddo, get ready, we're going to go to the mall, you can buy that new soccer ball you want. Why? Because, not that he's doing much better in school, because you haven't called the teachers. You haven't found out that they have a new principal who changed the rating system. You don't care. It's better than you expected. Now, if he would have told you Sunday at dinner he was probably going to get you all B's, you would have been happy with today's report, but not ecstatic. Why? Because then you would have been expecting it. So he goes out back, he's playing soccer with his kids, you're getting ready to go off to the mall with him, and the soccer ball comes through the back window, smashes the glass all over the living room, and now you're really pissed off. You open up the door and say, no mall tonight, no soccer ball, and get in here and clean up the glass. Okay. Now you're really mad because you've told him 100 times not to play on that side of the house. But this is what happens in the economics world also. One event can come out one moment and send a currency soaring because it was much better than expected, and a different event can come out or a different thing can happen. So you have short-term effects that don't last long, and then you have also the longer term. And you have to be able to grade these. And the fact is you can either make short-term trades or you can look for longer-term possibilities. Okay. For instance, if we see the non-farm payroll report on Friday is extremely good, that means we're probably going to get a rate increase. Now, if it's extremely good, we'll probably see the dollar bounce. Okay. But how far it will bounce and how long it will bounce could be a very short-lived thing. Now, you could trade the dollar to go up at a slow pace, or you could wait for an hour after the event and then trade the dollar to go up steadily, because then we're going to see all the headlines about the Federal Reserve turning, turning more hawkish because the jobs number was good. Or you could trade it immediately. Either way, it can be very complicated. But before you can do any of it, you have to learn how to build what we call our trading matrix. You have to determine how to evaluate the data that comes out. And you do that by building a matrix that we call market neutral, market negative, and market positive. And it's a simple way to evaluate the data and make a decision. Okay, because you can either trade the knee-jerk reactions or you can take longer-term trades to make it profitable. But you first have to know ahead of time, because either one of these, you have to do the analysis. You have to make the decision. You have to decide what's going to happen. So you have to learn to build this matrix. And the nice thing about it is you can build the matrix way ahead of time. You have the nice thing about the economics calendar, it gives you ample time to do your research, decide what you're going to trade, decide when you're going to trade it, how much you're going to trade, and then all you have to do is drop the data that's released into your matrix, and it's going to tell you which one of your choices to make, and you can just trade it at that point. So, because everybody who comes to this class always wants to deal with what is happening, and they always want to deal with the big events, we're going to look at, in this class today, Friday's non-farm payroll report. And we're going to try to evaluate it together. But first, we have to look at the economics calendar to learn how to read it. And we're going to try to do that relatively quickly. Okay. Because the data isn't, reading the calendar isn't that difficult. Now what we're looking at is, I just did a screenshot right before class. Okay. It's just easier going live online. What we can look at first is we're going to see the time of the event. Now every calendar, no matter which one you're using from what website that you're getting it from, will give you a way to set the date. You always want to make sure you set the time, the date, or the time, I'm sorry, to your local home time, because you don't want to make a mistake on an event because you miscalculated what time is getting released. So I always set everything to UTC time. I set all my charts to UTC. I set everything to one time because I just keep it there regardless of where I'm traveling, what I'm doing, because my brain functions one way. But if you live in the UK, set everything to UK time, GMT, GMT plus 1 or London time. If you live in France, set it all to Europe. If you live in Japan, set everything and make sure it's all set, and you're all set. Then the next column you're going to get is going to be the currency that is affected by the event. Now you have to remember that economic events were not developed for the Forex market. The calendars have been developed for the Forex market. But these economic events have been being released, some of them for 100 years. Okay. They are about governments and statistics and economics and economy of a government. Okay. Now, what we've done is we've taken all the events that are important to the markets and put them into this calendar. But again, a lot of these events, if you ever look at one of these whole releases, even if you go look at the NonFarm Payroll report, which has a big effect on the markets, and you think it's very important, and you see 4 headlines of data from it, but it is hundreds of pages long. It will give you each sector of the market, if it's healthcare, if it's nursing, and then it breaks down to healthcare, whether it's nursing, pharmaceuticals, sales, pharmacy, everything's broken down. Then it'll give you a sector of each geographic by, what cities and what part of the country the hiring was. Then it'll break it down to age bracket. It'll break it down by race, because all of this is important to other people. It's just not important to us. Okay. And the report wasn't necessarily developed for us. But you get what was called the headline reports. The important level, what you see here is the currency that's affected. And then in the name, you'll see that what we call the headline event. That is the major event or the major part of that report that is important to the financial markets. You also get what's called importance, impact, volatility, or tier. Take any level you want. The technical name is tier. Okay. Each of these websites, now because all of these websites get their data basically the same place, and they come from data feeds, there's very little that these, and they're hooked in directly by like APIs or whatever you call this computer stuff in these feeds, that there's very little that each economics calendar can do with this stuff, because they're just getting the feeds in. So all the economic events come in these 3 levels, and they're pre-rated. But here, like I'm using, this is investing.com. They use 3 bullheads for the top tier events or level 3 events. Some places will use 3 red exclamation mark. Some will use 3 stars. Some will use a number system. But it's always a 1, 2, and 3 because when the data feed comes in, it's coming in as a 1, 2, or 3. To tell if it's a 3 to put 3 bullheads there, if it's a 3 to put a red box there, doesn't make a difference. Each site can customize the appearance. Okay. And now all the sites also have filters. So what I've done here is I've filtered everything down to only the top tier events because I don't want a calendar that's going to go all over the page because I did this for just today's class. Okay. Now, we can see today that there are 2 major events because it also has holidays on there and tells you U.S. markets are closing early for 4th of July holiday, which is today. And then we had 2 events and we had a speech. Okay. Now, speeches are like news. You can't evaluate a speech because there's no data in a speech. You'd have to listen to what Mark Carney has to say and figure out how it affects the news. But he spoke today. Just like you have central bankers, you have all the U.S. central banks speaking. You have, Lowe out of Australia. You have Steve, whatever, I forget the guy's name, out of New Zealand. When all the central bankers speak, they're part of the economics world and the finance world. So they're on the counter because they can move the currencies. Now, we're going to look at this first event on today's calendar. Today is Monday. It's the first event of the day. And we can see here that at 8:30 this morning, there was an event in the UK. It was a top tier event, and it was manufacturing PMI. Now, I understand that most of you don't know what manufacturing PMI is and don't know the calendar that well yet. But PMI stands for Purchasing Managers Index. Now, PMI comes in a number above or below 50. 50 means whatever sector this is, in this case is manufacturing. Anything above 50 says expansion. Anything below 50 says contraction. So as long as you're above 50, it's pretty good. But how far above 50 is important because you still have expectations. It's like we have the Chinese data this week, and the Chinese manufacturing PMI has been hovering and is expected at 49.9. It's been hovering under 50 because manufacturing in China has been in contraction, which is a bad thing to begin with. But if for some reason it just peaks over the expectation of 49.9 to 50, that's going to be such a positive data that it's going to send all of the currencies that are affected by Chinese data skyrocketing. But in this case, above 50, we're all right. And then we want it to stay pretty close to what is expected. So we can see, number one, that this previous report, okay, when you see red, and I said I'm not on the live counter, you can see, this previous report came in at 56.4. Okay, in the previous, because you get what's called revisions. Remember I told you about revisions, whispered numbers, and all those. Okay, revisions are, we'll talk about in a minute. But we also had the forecast. That's the expectation or the consensus. That is what the markets are expecting and what they've adjusted to. They were expecting 56.5 today. What did we get? We got 54.3. Okay. So not only do we have a significant miss that was below expectation, but we also had a downward revision into last month. Now what happens is, because all this data is done so quickly that these agencies, these government agencies or these private agencies are doing the releases and the data are constantly updating them. Now, because they're constantly being updated, there are adjustments that are made. Say some big company didn't get the reports in late because the person who handled it was on holiday. So when they came in, they were adjusted. Okay. When the next report is released, they make a revision to the previous report. Okay. Sometimes if it was revised, you see it in red or green. A green means it was revised upward. A red means it was revised downward. Okay. Now, these numbers come from the reporting agencies that are releasing the data. Period. Yet. If it's Reuters, Thomson Reuters, that's where they report. Whoever owns the report, 90% of these reports are owned by the government. So when you have the NonFarm Payroll report, that's a government report. That comes from the Bureau of Labor Statistics. That's a government reporting agency for the Department of Labor. If you have things like PMI, which are done by a company called Marquette, or in China at Kumkaizen, or the U.S. the Institute for Supply Marketing. Okay. But these are recognized reports. And when you see PMI, the calculations, the algorithms are all the same. It's just who is collecting the data and releasing it. Okay. And for each country, it is one place. In Canada, it's the Ivy. In Germany, you have some big institutions, or you have government data. Okay. So before you get up your bonnet and start to think that people are rigging the data, they're not. These are huge, huge reporting agencies. And if their data is even out of line a little bit, they lose their credibility. This data is not rigged. It's not held behind. It's not released secretly to somebody else. Okay. They are basically as much as the public information releases. Number two, forecasts. Now, these data releasing agencies or government agencies releasing data do not do forecasts because this is not in their, they're collecting data, they're doing analysis. So there are a couple well-known forecasting agencies, and they vary ever so slightly. So sometimes you'll see the NonFarm Payroll report on one calendar only in forecast. The actual physical data release is always the same, but the forecast might be for 138,000 jobs on one economics calendar and for 137,000 on another calendar. Even the forecasts don't vary that much. They are very accurate. But if you're ever reading Bloomberg's and you see Bloomberg says our in-house analysis or our in-house staff of economists estimate this report or projected report to come in at 56.5. This website might be using their data feed for their forecast, but you might use Thomson Reuters, or they might be using CNN, or you have big agencies that also do this also. Okay. So they might be using one of those agencies. There's no published, none of the people on the calendar publish who they're using for their forecast. Now, you can pretty well figure it out if you're using a calendar regularly, but it doesn't make a difference because the currency and the market is not going to make any difference if the number comes out, if the forecast is 137 on one calendar for 137,000 jobs and 136.5 on another, because again, it's just a forecast, an estimate. Okay. But then what we come down to is the actual. Okay. And the actual to us is really kind of unimportant. Okay. It is the reaction between, or the difference between the forecast and the actual. That's the important part. Just like your kid's report card. If the forecast was at 54.3 and it came out at 54.3, which was a weak number, okay, but that's what the markets were expecting, then it's expecting. Because again, nothing on this calendar is doing any analysis. It's not saying, well, the UK is having a problem with manufacturing because the pound's down in value, but because of Brexit, and all of this stuff, all of the, the economy's ups, doesn't count to the calendar. The calendar doesn't care. The calendar only tabulates numbers and gives you numeric values. Because it's got to have true numbers, because these values can be used for many different analysis ways. Like part of the ISM manufacturing PMI, which came out much better than expected today in the US, is jobs created in the manufacturing sector. Well, because this report was so much better than expected, that means we might get an exceptionally good non-farm payroll report. That means manufacturing would have been hiring. Because if manufacturing is doing better than expected, they're hiring people. If services are doing better than they're expected, they're hiring people wherever they're missing. So it has a ramification down the road. Now, let's stick with this top event right here. Now, nobody expects you to learn all of this information that quickly. But again, the calendar is very, very nice because you see, we already knew a month ago that we had expected the or we knew months and months ago that today at 8:30 this morning, manufacturing PMI would have been released. We knew a month ago what the release was. Now the forecast usually comes out about a week before the data is released. No sooner than that, because you can't project anything. It would have no value that far back. In fact, in a lot of cases, it's only 3 or 4 days before. So figure you have 3 or 4 days to make your decisions or get yourself ready. Do your analysis. Now, what do you think happened to the pound today? All things being even, it's not a big news day. It's a holiday weekend for the U.S. We're going to summer for the Europeans. So most things that are going to affect the price of an asset are based on economics event, especially the first week of the month, because that's when most of the major economics events come out. Well, let's take a look at a chart for the pound. So I've already highlighted, this is a current chart for the pound that I took right before class. My blue line going down, and you can see the red E for the economic event, is when the data was released this morning for UK manufacturing PMI. Look what happened to the pound. The pound cascaded down and it's been down all day long since then. I mean, things don't just shoot down. It was up, down, peaks and valleys is how the market moved. But then it tumbled all the way down, recovered, and got a new level. But that's when the U.S. data came out, and the U.S. data was so strong that it supported the U.S. dollar, so that the dollar climbed this afternoon. So that pushed the pound farther down. So you have the decline of the pound on the weak event, and then the climb of the dollar on positive events out of the U.S. So it gave you two tradable scenarios. Went the wrong way here. So you could have traded the pound most of today, but the fact is you can't trade it that much later, because see, at 12 o'clock, Governor Carney spoke. Now, it happened to be, if he happened to say something about increased interest rates or higher inflation rates, it could have supported the pound and wiped out the whole decline. But at 8:30 this morning, when that release came out, and it was so weak, you sure could have gotten a solid trade in on the pound going down. Okay. When U.S. manufacturing PMI came out today, if you were trading the pound, you could have been sure that it was going to push the pound farther down because the pound was already weak. But this is the analysis you have to do ahead of time to be prepared for these events. Now, you also have to be aware of what is encompassed in these events, because you can only analyze what we call the headline piece of data. Okay, but you have to take into account all the things like revisions and sub-reports of this event. So let me pop up the actual economics counter on your screen. Okay, and what we're looking at live is the economics counter for Friday on investing.com. And we're looking at level 2 and level 3 events, but the only thing we're looking at is the U.S. non-farm payroll report, because I filtered everything else out of here. Well, we can see that there's 1, 2, 3, 4, 5 reports that are, 5 reports that make up this report. And there's hundreds of parts of the report, but these are the 5 reports that are important to the markets, that will have an effect on the currency markets and gold. Now, the most important is the level 3s. We see there's 2 level 3 events. Okay, that's part of this report. These are, like I said, the headline events. One is the non-farm payroll report, and that's the number of jobs created, and 2 is the unemployment report. Okay, but the unemployment report only moves in tenths of a percent, and it doesn't have that big of a factor on the market. So the first report we want to analyze is the full non-farm payroll report. So we can see last month we had a very dismal report. It was 138. This month we're expecting 179. So what you can do is start building your trading matrix by saying, okay, the market's expecting 179. You've got to decide what we call what's market neutral. What number around that 179 in either direction won't have a significant effect on the markets. It might be a slightly good, slightly bad, but it's not going to give you a tradable effect. It's not going to assure you the dollar's going to go up or down. Okay. So we have to find a range. The rest of these are what we call bumps. Okay. Since you can't analyze and keep adding all these on, but you have to take them into account, each one of these other reports that are part of this report will bump it, and so will any revisions. So first we have to decide what the area is around this number that we would consider market neutral. One of the best ways to do that, all the calendars you're using will give you these general same reports. Here, if we click on the report, it's going to open up a box, and it's going to give us a chart or a graph of how this report normally comes out. By using this report, we can see the average is at about 175,000 jobs. And I'm just guesstimating off the top of my head. So number one, we know where the average should be. Number two, we also can see down below how often it comes out higher or lower than this report. And we also get to see what kind of number this report. When we're looking at Canadian jobs, sometimes we're looking at 5,000 jobs. When we're looking at jobs out of New Zealand, we're looking at hundreds of jobs. Okay. When we're looking at a new job creation in the UK, it's usually about 15 or 20,000. Well, the US, we're talking about 107. So first you have to get it in prospectus. Then we have to see if we can get some kind of significant average off of this. Now, we can see a very bad report here. That was a horrible report. Then the next month it soared back up, because you also have to remember these reports come out in very tight increments. And things like the jobs report can be affected because, say for instance, you have a holiday and a Friday all come together in the end of a month. So people are hiring everybody because it's not based on when they said, okay, you have the job. It's when they put you on the payroll. So they can hire you all, tons of people in the month, but because it's a 3-day weekend and they tell you all to start on the first of the month, or like if they hired you last week or were interviewing for you last week and you were in the US, they tell you to start next week. Because why? It's the 4th of July holiday. Everybody's off half a day Monday, all day Tuesday. A lot of people take Wednesday off. So if they were doing new hires, they would hire you to start the following Monday. So if that report came out, it means they still hired the same amount of people, but where it falls in that report. So sometimes when we have an awful report, the following month we'll have an extremely good report. Okay. And we can see that here we had an exceptionally good report the prior month. Okay. And we had a terrible report this month, but we also had a revision in that prior month. So that prior month we actually had 235,000 jobs when we have an average of 75,000 to 175. So we were what? 65,000, 60,000 above. So here we had this terrible report, and we only had we had 79 actual, but it was revised to 98 down the road. And take 98 and add the extra 65 from the prior month, we ended up with a very average report. So this is what the feds are looking at. But the market doesn't look at this. The market reacts instantaneously to knee-jerk reactions. So we're looking at 179,000 tomorrow. And we can see that the report, if it comes out fairly close to that, so we're going to give a bump of 10,000 jobs on either side. Okay, actually we're going to give a bump of 5,000 jobs, 10,000 a gap, 5,000 either side. So we're going to say if this report comes in better than 170, higher than 184, it's going to be very market positive. And if it comes in lower than 174, it's going to be very market negative. Okay, so we have market neutral would go from 184 to 174. What that's saying is that there would be no tradable effect out of that report at that number. Okay. Anything above 184 is considered market positive, and because we were using a 10,000 gap here, we're going to say the next level was at 194. Over that is market positive. And you'll see why we have to below from 174 to 164 is market negative. And then anything below 154 is terrible. Okay. So that's where we start our matrix or our premise. So we've now got this number taken out. Now, because we could get a revision when this number comes out, we have to be able to mildly move this number. So we call these bumps. So hypothetically, if this number came in exactly where it was expected at 179, and we had a revision upward, which would have been a positive revision, we could say that that bumped it from that 179 into a market positive territory, that it might give the dollar a bump up. Okay. If it came in at 179, it was negative, it might have pushed it down into the negative gap, because there's no way that we can figure out exactly what that number would be. Now, if we had got this report, say, at 182, so that 182 was still in market neutral territory, and we had a positive revision, that would have definitely paced it into market plus. But say we had a report at 186, and we had a downward revision, that would have pushed it back into market neutral. But then we still have to take into account the unemployment rate. Okay. Now the unemployment rate carries virtually no, unless it's a horrible number, because most time it's a statistical anomaly. So if this came in at 4.1% compared to 4.3, it would be positive, but it's not a very strong positive. It came in at 4.5, it wouldn't be as strong, it would be a slight bump, because most likely next month it will balance itself out, because it's usually statistical, because the weekly unemployment reports have been bad. We would have already seen the files for claims. It hasn't been. So a lot of times it's because of the numerical calculations, the algorithms used to do this. Then the next number we have to look at is and this has now become the crucially important number, which is the average hourly earnings. Because now that we have almost full employment in the U.S., 4.3 is an exceptionally low unemployment number. We're more concerned with people making money. Okay. Because if a lot of people were underemployed and went back to work, well, that's not very good for the economy. Whereas if people that are working are increasing their hourly rate, that becomes very good, because that'll allow inflation to ease up. That allows inflation to go up, and at the same time, people are making more money. So if you took a job that was below, what your salary level should have been, because we had, the bad economy, well, you can see you're now getting wages. Or when people's wages are going up, you might leave the job you took, 3 years ago, 4 years ago, when they were offering you no money, and go market yourself for a higher salary for the job you had before. Okay, so we want to see wages climbing. So this, if it comes out of 0.3, it was pretty okay. If it comes out lower, it's a big bump, because we don't want to see this. If it comes out higher, that is even a bigger bump. If we have a revision, most likely it'll be revision upward. That becomes a bump. So you have to keep adding these bumps up and down to put them together. And what happens is all of this data is released within a minute of each other. It comes out the report, then the revision, then the next report, the revision, the next report, the revision, the next report. They're all, basically, they're being released faster than you can do anything because they're shooting right through the data feeds right out to your calendars. So a lot of it depends on the calendar you're using and the refresh speed. I can't help you with that because you'd have to find which ones do it on your own, but some have a much faster refresh speed. If you're paying for calendars or you're getting a calendar from a higher level service, it's got a faster refreshing. It's not the way the data comes out to you. It's how fast that website is refreshing the data you're looking at. Okay. So maybe the first time, a couple times you want to use it, you'll have 3 different calendars up on your screen. See which one actually pops up the fastest. Okay. For me, it doesn't make a difference because I'm not making that big of a trade that quickly. Okay. I mean, if it varies, it's a vary of a couple, 10 seconds, 20 seconds, 30 seconds. But you should be aware of that. Okay. So now what you have done is you've built this matrix ahead of time. Okay. You've done some studying and you've made your decisions. So when this report starts popping out, all you're doing is you've got a little spreadsheet with all of this laid out. You're just picking off your boxes on your spreadsheet. And at the end, you end up with this number with so many bumps that way and so many bumps this way. And you say, oh, that put it right in this game. That's going to be positive for the dollar. And then you can go make your, because you've already decided what assets you're going to trade, how you're going to trade them, what direction you're going to trade them when they ahead of time. Because again, because you could do the research on this ahead of time, and that's what you should be doing. That's the nicest thing about the economics calendar is that you have the ability to prepare yourself. It's very rare in the markets that you have time to prepare ahead of time. Now, for instance, I very quickly, I didn't write this. I found it in a news article. But here, U.S. Non-Farm Payroll report, Friday at 12:30 UK time. The king of Forex indicators with us and the wages remain no less important than job growth. Back in May, the report was very disappointing. It was very disappointing, but the Fed raised rates anyway. It was only 138,000 jobs were gained, and year over year wages advanced only to 2.5%, remaining stuck. While the next rate decision is not accompanied by any new forecast, it could certainly impact the tone of the Fed. This time, a gain of 175,000 jobs is expected. So see here, it's 175. On investing.com is at 179 because it was 2 different services. But again, the 3,000 jobs if you're using a $10,000 job spread, what's 3,000? You're talking about a minor percentage. But this is what wage growth is forecast to rise by 0.3 month over month after a 0.2 last time. The unemployment rate remains, expectations remain at 4.3 as seen last time. You have ample time. Believe me, at every one of these reports, there's more than enough news information, everything ahead of time to help you understand. Or if this is the first time you're trading them, to learn what they are, to learn what PMI is. Go to Marquette's website. Go to ISM's website. They'll explain it all to you. You can see prior reports. And it'll give you time. It's one of the few ways that you can trade in the markets where you can actually build everything ahead of time. That's not using indicators and oscillators and all this complicated stuff. It's pretty easy to figure out what events affect what assets, what cross asset you'd want to trade, make your decision, be prepared for it, do your research, and then just be sitting there waiting for the final. Okay. And it gives you one advantage. Okay, Trevor just wrote in, and I don't understand this stuff, but there's an argument that most professionals, should I say, a lot of professionals say that you should avoid the NFP. There's an acronym for NFP, not for professionals. This is all retail market bullshit. Okay, it's like buy the rumor, spread the news. Let me tell you, most professionals are trading with computerized systems that are evaluating data and making decisions so fast that you as a human being couldn't make that decision. Okay. If you want to trade the NFP, you have to do the research, do the strategy, and understand it. Okay. If you don't want to trade it, lots of people don't trade from the news. Okay. There are many ways. You have to figure out which way you're going to trade. I haven't told you where to enter the market, what price to enter the market, where to exit the market. I told you you have a long-term strategy and a short-term strategy. Okay. You decide. Making your decisions are yours. Making general accusations about the market are, you decide you want to follow. Not for professionals, then don't trade the NFP. Okay. But there's a million other retail Forex traders, and every hedge fund, everything out there is already taking position. Again, I'm not going to tell you. Somebody just asked, when will you enter the market? That's completely up to you. We're not here learning strategy. You have to decide. You have to do the research. You have to make the decision. Making a trade is a lot different than making an analysis. You have to decide if you're going to wait 15 minutes, wait 30 minutes. Do your strategy, do your homework, and figure out how you're going to trade. I can teach you how to analyze it. I'm not going to teach you how to trade. You should figure out what strategy you want to use. And I will recommend you to go forward with that. Okay. For the person who says, can I talk? I registered with X90 and I'm facing a big issue with my account. I'm paid for X90 to give classes. Okay, I have no internal contact. I have nothing to do with your account. Account management's got nothing to do. I'm a certified instructor and a certified investment instructor. I got nothing to do with your account. Okay, if you're having problems, contact compliance, and I'm sure they'll be more than glad to help you. This is not the right place or not the right arena. So thank you very much. Okay, have a very nice day. Thank you very much for joining us, and best luck trading out there. Bye now.